Welcome to Chapter 3, Researching Funds, the User Guides. Most investors begin with the fund's name and its recent return. That is convenient, but it is usually the wrong order. In this chapter, we will learn how to read the documents, holdings, filings, and analytics that sit behind the label. Think of it as financial detective work. The clues are objectives, fees, risks, benchmarks, portfolio positions, and governance. And no, the case is not solved simply because the fund has 5 stars. By the end, you should have a repeatable process for turning disclosure into an actual investment judgment. 2 funds can use the same friendly adjective and still own very different risks. An income fund might emphasize dividend growth, high-yield bonds, covered calls, or a concentrated group of utilities and banks. A sustainable fund may use exclusions, engagement, best-in-class scoring, or some combination of the 3. The names rule can require an 80% investment policy, but the name is still a name tag, not an X-ray. In markets, labels become especially seductive after a strategy has had a good run. That is often when the marketing department discovers new adjectives. Our defense is a disciplined workflow: objective, fees, holdings, risks, performance, and governance. We triangulate because no single source is complete, perfectly current, and free of incentives. By the end of this module, you should be able to do 4 things. First, navigate the disclosure stack and explain what the summary prospectus, statutory prospectus, statement of additional information, shareholder report, and SEC filings each contribute. Second, extract the facts that actually drive a decision, including strategy, fees, risk, benchmark, and portfolio evidence. Third, diagnose common research problems such as stale data, style drift, survivorship bias, and a misleading peer group. Finally, synthesize the evidence into a short fund memo for an investor, advisor, or oversight committee. The goal is not to memorize document names. It is to know which source answers which question and when that source may be incomplete. The chapter is organized around 4 connected questions. First, what belongs in the disclosure stack, and how often does each source update? Second, what is the fastest sensible way to read a prospectus and shareholder report without letting performance dominate the analysis? Third, what do the holdings reveal about the fund's real exposure? And fourth, how should we use categories, ratings, style boxes, and benchmarks without letting the shortcut become the decision? Think of the sources as different camera angles. One shows the promise, another shows the portfolio, and another shows how outsiders classify the fund. The source determines what we can reasonably infer, so we should never ask one document to answer a question it was not built to answer. Start with the promise, then work toward the evidence. The summary prospectus is the executive overview, objective, fees, strategy, principal risks, performance, and management. The statutory prospectus adds the full offering terms, purchase and redemption rules, taxes, and intermediary arrangements. The Statement of Additional Information, or SAI, is where the fund keeps the plumbing: board details, brokerage, custody, portfolio manager information, and operating policies. It is not glamorous, but plumbing becomes very interesting when something leaks. The shareholder report shows recent expenses, performance, holdings, and portfolio discussion. Form N Port and Form N Scene provide structured regulatory data, while fund, websites, and commercial data providers may be timelier and easier to use. The research question stays constant. What does the fund promise, and what evidence supports that promise? The slide frames the process as 7 deliberate passes. A practical way to think about it is 6 reading passes, followed by a 7th decision pass. Does the fund actually fit the investor? Begin with the objective. What job is the fund trying to perform? Then examine fees, because cost is one of the few inputs known in advance. Translate the strategy into actual exposures and constraints. Read the risk section by asking how each risk could create a loss. Only then review performance, benchmarks, and after-tax results. Finish with the people, purchase terms, taxes, and compensation arrangements. Investors often start with last year's winner. The market has a habit of changing the exam right after everyone memorizes the answer key. Reading in order helps prevent performance chasing from crowding out fit, cost, and risk. Risk language becomes useful only when we translate it into a loss mechanism. Market risk means prices fall broadly, but the damage depends on beta, concentration, and liquidity. Credit risk means spreads widen, a rating falls, or an issuer defaults. Duration risk means yields rise and bond prices fall. That was not a textbook footnote in 2022, when many investors discovered that the income may be fixed, but the price is free to improvise. Liquidity risk appears when a security can be sold only at a meaningful discount or not quickly enough to meet redemptions. Currency risk can erase a strong local market return, and strategy risk can hide and leverage options, derivatives, or concentrated themes when the same risk label can represent a very different probability and severity across two portfolios. Do not ask whether the prospectus lists the risk. Ask how the risk reaches the shareholder. The prospectus fee table is essential, but it is not the investor's complete invoice. It identifies shareholder charges, annual operating expenses, and a standardized dollar example. That makes funds easier to compare. But total cost can also include an advisory fee, platform or account charges, bid-ask spreads, market impact, and investor-specific taxes. The share class matters, and so does the channel through which the fund is purchased. A no-load fund inside a fee-based account is not free. A zero commission trade is not a zero economics relationship. Somewhere, someone still has a revenue line. The right habit is to compare the fee table with the actual account arrangement and expected holding period. Costs should be traced from the portfolio all the way to the household because small recurring percentages compound with remarkable discipline. The performance page gives useful evidence, but it also creates predictable traps. Calendar year bars show the path, including volatility and drawdowns that an annualized average can hide. 1, 5, and 10-year returns provide context, but the endpoint matters. A benchmark helps only when it matches the fund's opportunity set, currency, and risk. After-tax returns can reveal whether turnover or distributions matter in a taxable account. Then come the traps. Recency makes the latest winner look permanent. Survivorship makes the database look cleaner because the cemetery is not always included in the average. Style drift can make an old benchmark irrelevant, and the wrong peer group can reward a fund for taking risks its competitors did not take. The question is not simply, did it win? The better question is, what decisions and exposures produce the result, and are they likely to persist? Holdings are where marketing meets reality. Start with the largest positions and ask how dependent the fund is on a small number of outcomes. Then examine sector and industry weights. A fund can sound diversified while quietly making a large bet on banks, technology, energy, or interest rates. Separate country of listing from currency, revenue exposure, and issuer domicile. For bond funds, connect the advertised yield to duration, credit quality, spread risk, and default exposure. Turnover can signal active implementation, tax realization, capacity pressure, or a genuine change in process. Finally, check cash and derivatives. Futures, swaps, options, and cash can materially change effective exposure beyond the physical holdings. Cash can be dry powder, a redemption buffer, or simply a return drag. Holdings should either confirm the stated strategy or generate a very specific list of follow-up questions. Fund disclosure has been moving from a legal document endurance test toward layered, more visual reporting. Before the summary prospectus, investors often received long documents with little help identifying what mattered most. The summary format improved prioritization, online delivery improved access, and structured data improved machine readability. Tailored shareholder reports now focus more directly on fund-specific expenses, performance, holdings, and material changes. That is progress, but shorter does not mean simple. A 3-page report can still sit on top of a complex portfolio. New APIs and artificial intelligence tools can lower search costs, but they can also produce a confident summary of stale or misunderstood data at impressive speed. Better design helps investors find the question. It does not eliminate the need to verify the answer in the underlying filing. The names rule asks whether a descriptive fund name creates a reasonable expectation about the portfolio. For covered names, the fund generally needs an 80% investment policy tied to the meaning of that name. The terms must be interpreted in plain English. The fund needs a process for classifying investments and monitoring departures, and the prospectus must explain the policy and measurement approach. This matters because the market has never met a popular adjective it could not turn into a product. Growth, value, income, sustainable, artificial intelligence, and thematic labels can all shape investor expectations before the holdings are reviewed. But remember what the rule does not do. A compliant name does not guarantee low risk, diversification, good performance, or a reasonable price. The rule polices the label. It does not certify the investment. Third-party analytics are valuable because they normalize data, organize peer groups, summarize style exposure, surface holdings, and support screening at scale. The problem begins when the shortcut becomes the conclusion. Category definitions differ across providers. Ratings are backward-looking. Holdings can be stale. Survivorship and incubation can bias a sample. And a single score compresses costs, risk, people, process, and portfolio change into one convenient symbol. A 5-star history can easily outlive the team that earned it. That does not make ratings useless. It makes them question generators. Use a rating to ask why the fund scored well, whether the same process is still in place, and what risks the score does not capture. Stars are useful assistants. They make terrible portfolio managers. This map forces us to separate two dimensions that fund labels often blur: concentration and factor, or style intensity. A broad dividend index may own many securities but still carry a meaningful dividend or value tilt. A concentrated high-yield equity fund may depend heavily on a few sectors and a strong income factor. A market-like income fund may be broad and only modestly different from the market. A covered call strategy can hold familiar stocks while producing a very different payoff because the option overlay changes the return pattern. The exact coordinates are less important than the habit. Before accepting the label, ask how concentrated the portfolio is and how strongly it loads on a particular factor, sector, or implementation technique. Same adjective, different geometry, and often a very different investor experience. Consider two funds that both appear in a dividend screen. Fund A owns profitable companies with long records of raising dividends and offers a moderate current yield. Fund B targets the highest available yields and is concentrated in financials, utilities, and energy. These are not substitutes. Start with the objective. Is the investor seeking current cash flow, dividend growth, total return, downside resilience, or a factor tilt? Then inspect holdings, payout sustainability, leverage, sector concentration, and valuation. Check whether the benchmark reflects the strategy. A broad equity index may be a poor comparison for a deliberate high dividend portfolio. Market regimes can also flip the result. A sector-heavy, high-yield fund can look brilliant when energy or banks lead, and painful when they do not. two restaurants can both advertise light fare, the ingredients still matter. The investment job, not the marketing adjective, should drive the choice. Here's the repeatable workflow. Step 1 is the job. Define what the fund must do inside the portfolio. Step 2 is the promise. Read the objective, strategy, benchmark, and principal risks. Step 3 is the price. Identify the full fee and channel economics for the correct share class. Step 4 is the portfolio. Test the promise against holdings, factors, duration, credit, concentration, cash, and derivatives. Step 5 is the process. Evaluate the people, turnover, capacity, governance, and implementation. Step 6 is the proof. Interpret performance, attribution, drawdowns, and peer results over a full cycle. And the 7th step is to write the decision. In one page, state the fit, evidence, cost, risks, and measurable review triggers. This order makes it much harder to fall in love with a performance chart before learning what actually produced it. Now apply the process. A mid-cap fund replaced its portfolio manager 9 months ago. Turnover rose, large cap exposure increased, and the benchmark did not change. The data provider still displays a strong 5-star history, mostly earned by the previous team. Pause the video and choose the 3 sources you would review first. When you resume, here is one defensible approach. Start with the current holdings page, Form N-Port, and the latest shareholder report. Those sources help establish what the fund owns now, how quickly it changed, and what management says it is doing. Use the manager interview as supporting explanation, not as the primary evidence. Treat the inherited track record cautiously because performance belongs to the people and process that produced it, not to the ticker symbol. Monitor average market capitalization, turnover, concentration, factor exposure, and benchmark fit. If the portfolio changed faster than the rating is driving by looking in the rearview mirror. Pause the video and answer these 4 questions before continuing. 1. Which document most directly summarizes the objective, fees, strategy, principal risks, and performance? 2. What is the strongest use of a third-party star rating? 3. Why can a benchmark be misleading? And 4. What does an 80% names policy primarily address? Pause now. When you are ready, here are the answers. Number 1 is B, the summary prospectus. Number 2 is B, a question generator and historical screen. Number 3 is B, because the benchmark may not match the fund's actual opportunity set or risk. And number 4 is B, investment consistency with a descriptive name. Yes, all 4 answers are B. Finance occasionally rewards consistency. Carry 6 ideas into the next chapter. First, triangulate. No single document is complete, current, and free of incentives. Second, read in order. Start with the investor's job, strategy, costs, and risks before recent performance. Third, test the label against holdings and effective exposure. Fourth, match the benchmark to the actual opportunity set, currency, risk budget, and time period. Fifth, use ratings carefully. They compress evidence and can lag a material portfolio change. Sixth, write the decision. A concise memo should state why the fund fits, what evidence supports the choice, what it costs, what can go wrong, and what would trigger review. A useful research memo should survive contact with a bad quarter. Next, we will use this evidence to compare funds rigorously rather than simply ranking last year's winners. The textbook remains the conceptual spine of this chapter. The modernization layer relies on primary sources from the SEC, including prospectus guidance, Edgar filings, tailored shareholder report rules, Form N-Port, Form N-Sen, and the names rule. FINRA's Fund Analyzer supports cost comparison, while Morningstar's methodology helps explain how style and category tools are constructed. The practical research lesson is simple. Begin with primary documents and official filings, then use commercial analytics to organize and compare the evidence. Commentary can be useful, but it should not outrank the underlying source. The full links remain on the slide for students who want to explore them. In Chapter 4, we will take this research process and use it to compare mutual funds on a fair, risk-aware, after-cost basis.